and welcome to this episode 5 of Kairos Radio, sponsored by ao.gold. This is David Holland. I am your host for this episode, first and second part of this episode. I appreciate you coming along for the ride. I know it's been an interesting few days, weeks, months. It's been an extremely interesting year here, starting off May. I believe this is where we're at on the calendar, getting into May, and typically springtime, everything's coming out. It's probably already getting really hot. If you're listening to this outside of Texas, wherever you're at, it's summertime here in the Northern Hemisphere. And usually that means getting ready for summer, getting ready for a time of relaxation, a time of resting with the family, maybe going off to the mountains, maybe going to the beach, maybe going to California, maybe going to the Florida, maybe going somewhere that's not Texas. But at the end of the day, I think after our conversation today, maybe this is going to be a little bit different summer. It might be a summer of very high gas prices, a summer of shortages. It looks like we're in the middle of the pandemic shortages of 2020 through 2022, when things began to crop up. And we had issues with people buying and things not being available. This is a little different with everything going on. With the Strait of Hormuz closed, we are beginning to see shortages around the world in places like Asia, where they depend mostly on what comes out of the Persian Gulf. We are seeing a hoarding and shortages of things like syringes, medical supplies, medicines, even people hoarding plastic trash bags. So things are starting like they did last time, and starting in Asia, and will eventually come to our shores. And a lot of times we feel isolated because we have large oceans between us and the rest of the world, but we are in an interconnected world right now. We are in an interconnected place where we depend on other countries, other supply lines, supply chains, other economies to make our economy go around, just like they depend upon us. And the strain over there will eventually show up over here in possibly unexpected ways. So today is not about going out and buying extra trash bags or buying something that you need, even though you should be doing that. You should be looking out into the future and saying, if it wasn't available, what would I want extra of? And you should probably buy a few extra of those. No hoarding. I don't suggest hoarding. It's usually too stressful and doesn't really get you anywhere. I'm thinking back to mountains of toilet paper back in the COVID era. But we should just be prepared for normal things, normal outages, normal. If I'm a diabetic and I need syringes, what if I don't have any? Do I have an extra box, or do I have an extra bag? And things of that nature. There's going to be plenty of things that you personally or family has that you should be prepared. But today, I want to get into how is that going to affect our economy and the high prices and the drag of the economy. We're in a season where large corporations, the Magnificent Seven, have been reporting their earnings. And of course, they're always great. It seems like the earnings just go up and up and up. And the stock market keeps going up and up and up. And if you're invested in those things and they go up and up forever, then that's great. But it doesn't seem like forever is going to be long in the cards. I think last time, if you tuned in, we talked about warning signs in the economy. The Buffett indicator was reading recently here where it shows that the Buffett indicator is now around 230% of GDP. And I believe at the height of the past recessions in the dot-com, let's see, here's a figure right here. So in historical context, right now where we are with the U.S. stock market capitalization as a percentage of gross domestic product at 230% currently is where we sit. In historical context, during the peak of the 1929 bubble, so that's right before the Great Depression, that figure was at just 65%. During the dot-com mania of 2000, it hit 170%. So we're far exceeding the dot-com bubble. We're basically in uncharted waters, and I guess what you could call hyper-financialized territory. And it's, there's going to be a reset of some sort coming up, whether that's tomorrow, whether that's 2 or 3 months from now, 6 months, a year, couple of years. There is no specific way to tell unless you have an inside track and when the bubble's going to pop and who's got the pin and who's going to push it. But with the pressure of oil, energy, the pressure of diesel prices specifically, because diesel runs the world economy when it comes to shipping, when it comes to transportation, when it comes to delivery, when it comes to everything that works out there that keeps the economy humming. That energy is the lifeblood of it. That diesel is very critical to that. And we have to be aware that this is not something that is just going to be fixed in a matter of a few hours, or turn on the faucet at home and then water comes out, or turn on the faucet and have the diesel and the gas flow. That is not necessarily going to happen. So we have to be prepared for that. And again, that's why we advocate gold and silver. We advocate precious metals. Gold and silver are a safe haven. I don't care what anyone tells you. History is not on the side of people who say gold and silver have passed their prime, that they're, a relic of the past. You tell that to large corporations, tell that to Tether, who runs the USDT, the Tether coin. They have stocked up on gold and been stocking up and own quite a bit. Other large corporations are partnering with silver refiners, silver institutions to stock up on physical silver as part of their portfolios. Obviously, central bank buying, China, India, these large countries that have a large manufacturing presence, they are stocking up on physical precious metals as part of industrial demand and as part of banking reserves. So gold and silver becoming the reserve assets universal again. This is something that is very, very important and is going quite quickly. And we get a little blurry in the vision when we're here in America, just looking at the Dow Jones getting close to all-time highs again, NASDAQ doing very well, everything just kind of going bananas, if you will, but also knowing that this is not where it's very safe. This is not a good place to be. Physical gold and silver represent stores of value. So I want to read a little bit of something. Actually, I'll read that in the next segment. We'll pick it up. But I want to go into what money is, some definitions of what money is, taken from a paper or a book published by a fellow named Mike Maloney about money and what that is. And I'll dive into that in the next segment, and what money looks like and what currency looks like, what we have now and what that is historically been. And we know historically that all cash, that all paper fiat money that's printed solely on the behest of the government and the money printing machines and the Federal Reserves and the central banks, that is not backed by anything but full faith and credit of a government, that these have all ended in failure. These have all ended in a bad situation, dissolving of empires. Think the Roman Empire. Think, obviously, post World War I Germany. That was a little bit different setup, but it has the same effect nonetheless. You cannot just turn on a money printer and solve the problems. That doesn't work. Right now in Iran, they're having that same problem. They are quickly finding out that they can't just print money and have it work, that without the flow of oil from their country and the exchange of energy for currency, for money, that they're quickly going to be drowning in worthless reals, I believe is their local currency there. So they are having a problem, and America will soon be having that same sort of problem. I am a pro-American. I am an American. I'm a back to the 1500 American from my family. But at the end of the day, you cannot American yourself out of what is bad and has been bad government printing policy. This calls for a radical change. This calls for radical preparation. This calls for getting back into what is stable, what is fit, what is going to hold value through transition, because we are entering into a time of transition. Like it or not, transition is here. We're going to be transitioning from the old world, pre-AI, pre-automation, and we're going to be transferring and transitioning into a new world that is going to be full of loss of jobs, loss of the way of life that we've known and loved. And we have to be ready for that. We have to be prepared for that. If we sleepwalk into it, it's going to be very, very difficult. If we're prepared for it, then we have more options to take care of ourselves, to take care of our families. If we handle the transition well, then we can help others transition into the new world with assets, with resources, with the ability to take care of ourselves and not be dependent upon Uncle Sam, not to be dependent on digital money handouts and government breadlines and things of that nature, because that world is transitioning very, very quickly. And I would say, in my opinion, but if we knew how close it was to this transition time, none of us would be able to sleep at night. We would be too busy trying to prepare or figure out what we needed to do. So with that being said, I'll see you in the next segment, and we'll get into what is real money and what is not. Hi, this is David Holland, founder of ao.gold. Let me be direct for a moment. Things are changing, and they're changing quickly. Inflation is still eating away at purchasing power, the national debt continues to climb, and the financial system is more fragile than most people realize. You don't have to be an expert to see this. You can feel it every time you go to the store or look at your savings. The real question is, what are you doing about it? Because hoping things get better is not a strategy. At ao.gold, we help people take action, real, practical steps to protect what they've worked hard for. That means moving a portion of your savings out of vulnerable paper assets into physical gold and silver, assets that have held value for thousands of years. This isn't about panic, it's about preparation. And here's the truth, the people who wait until everything is obvious are usually too late. We've already seen banks fail, we've seen markets swing wildly, and when confidence shifts, it happens fast. That is why we're having more conversations than ever right now with people just like you, people who simply want to protect their retirement, their savings, and their future, whether it's rolling over an IRA or 401k, or just getting started with physical metals. We walk you through it step by step with honesty, clarity, and zero pressure. But you do need to take that first step. Go to ao.gold. That's ao.gold, or call us today at 855-426-4653 and talk to a real person who can help you understand your options. Don't wait for the next headline to make the decision for you. This is David Holland with ao.gold, encouraging you to prepare wisely, take action, and protect your future while you still can. And welcome back to Kairos Radio, the second segment here. I'm your host, David Holland, sponsored by ao.gold on the web at ao.gold. I also want to throw in a little link to our booklet that we have. It's ao.gold/book, BOOK. That'll bring you to a form. If you fill that out, we will send you what we have titled a book that's called Should Christians Buy Gold? And that would go for anyone, because you don't necessarily have to be a Christian to buy gold, but obviously we are a Christian company. We are in that space. And so, we're happy to talk about that as well, and what the Bible says about gold and God's perspective and the economy and how things work. But you definitely, don't have to be a Christian to take advantage of that. We're happy to help anyone who comes looking, anyone who needs help. But within that booklet, I want to go over a little bit, and we'll jump into a few other items that are on there. So again, mentioning the website ao.gold, and the booklet, if you want it, is ao.gold/book, BOOK. So just go there, type that in, and it'll bring you there. So in part of that booklet, we have why is gold valuable, what it is, what is money, what is currency. This is taken from, in this context, is taken from a fellow named Mike Maloney. He has a Hidden Secrets of Money series, really good series. Definitely should check it out. But in this, he talks about what money must have to have a characteristic. So what defines it? One of the first ones is medium of exchange. It must generally be accepted as payment for goods and services, facilitating trade and transactions in the economy. It enables buyers and sellers to exchange value without the need to barter. So it makes it a very easy to buy and sell. So medium of exchange, that's the first thing money must accomplish to be called money. Second would be unit of account. It must be a standard numerical unit of measurement. So it must have some uniformity to how it is set forth as far as weights, measures, things of that sort. Think dollars, dimes, think grams, ounces, quarter ounces, things like that. So if you're talking about money in units of measurement, so that we can all be on the same page, in other words. Portable, it must be capable of being transferred from one place to another. For example, real estate can't be money. It isn't easily transferred from one place to another, nor is it easy to transfer ownership quickly. So needs to be portable, needs to have some portability. It's funny, gold and silver are often referred to as real estate you can put in your pocket because it takes up space. So past portability. So number 4, it needs to be durable. It must not easily wear down or rot. For example, you can't use agricultural commodities as currency or money. They aren't durable over time. They spoil or rot. So needs to be durable, needs to last. Needs to be divisible. It must be capable of being broken down into smaller units to make change, to balance exchange for goods and or services. So yeah, breaking it down, hiding it up, that is something, you hand them a $20 bill, they give you back a 5 and a couple of ones and some change for a burger. Or you just hand them now a $20 bill and you just get a burger because it's going up. That's neither here nor there. Off subject, sorry. So number 6 needs to be fungible. Fun word there is fungible. It must be interchangeable, meaning one unit is the same as any other. For example, $1 is the same as $1. They're interchangeable. On the other hand, diamonds aren't interchangeable. Not all diamonds are the same. They come in wide variety of sizes and grades. And then 7, it has to be a store of value. It must be able to be exchanged for something in the future without its purchasing power deteriorating. And so this final characteristic is what really sets precious metals apart from our current money supply, from dollars, US dollars. It is a store of value. It is what differentiates money from currency, in other words. So currency is just, it can be whatever you would like it to be, whatever you and other people, accept as currency. Right now, we all accept the dollar, so to speak, as a currency of a medium of exchange more and more every day to meet the same needs, but it's still a medium of exchange. But money needs to have a store value that doesn't deteriorate over time. So gold and silver, but gold primarily, is not subject to the arbitrary whims of a governmental authority. No government or central bank can print as much gold as it wants. So that's why you see them buying it right now by the ton, consistently over time, and not selling it. A few have sold it here and there to keep their currencies, to keep their national currencies from tanking. But all in all, they are net buyers by a wide margin of gold to prepare for what they see as the changing US dollar world order. So that is a quick history lesson, a quick understanding of what the difference between money and history is. Again, you can find that in our book, Should Christians Buy Gold? We're happy to send that to you. Just go to ao.gold/book, or just go to the homepage at ao.gold and put in the notes there. In the message, just request the booklet. We can send that to you. It's not a problem. And it's a nice little PDF. You can go through it and see how that can be a benefit and read up some more. There's plenty of other examples as to good questions, why people ask, arguments, why people say it isn't what, they should do, especially from a Christian perspective of the Bible says, gold and silver will be worthless and thrown in the streets. What about that? Good example of a common rebuttal that, scripturally speaking, doesn't hold up for the context in which it is put. And so we give it a pretty good layout there. So go there, sign up. We'll send that over to you. Happy to do that. But before we go, I want to jump into a few more stories here. And this is for just recent news. So we're seeing this shift away from what has been termed a 60-40 split. There has been a kind of a move to a 60-20-20 split when people invest a retirement account. So this new 20% that has taken place is now moving into hard assets. So you have Wall Street quietly shifting to a 60-20-20 split. Example, Morgan Stanley CIO is now openly recommending 20% gold allocation as a core portfolio component. That comes from a Canadian mining news story. Gold is being framed as an anti-fragile asset, replacing treasuries as the primary hedge. So these are things that the world has been moving to, and now Wall Street is moving. So Wall Street is admitting that bonds, which used to make up the 40%, are broken, and gold is basically the new defense. That is what they are telling us by recommending and starting to move that way. So it's a diversification model. So they're wanting to get out of just being primarily in U.S. assets. The world is moving away from that, and now the big banks are moving away from it. So there's, at the same time, a massive capital rotation into hard assets. Basically, billions are flowing into mining, metals, energy, and real estate. And real assets, things that have a tangible value. They're not financial products. They're not, stuff that's just kind of created out of thin air. It's not fiat. It's companies and institutions are wanting something that they can tangibly stand on, hold, and offer going into what we're facing. Basically, a lot of this is driven by the AI infrastructure needs, by the war risks that they see ahead, and inflation fears. They know these assets, these tangible assets, will continue to have their core value intact despite what comes through. So basically, this isn't retail. This isn't like, passing whim of, people wanting something that's not in Wall Street. This is a institutional money. These are billions and billions of dollars of institutional large investors, of the people that make up what we would know as Wall Street. They're the ones that are moving into these hard assets. So gold is still, another story here, gold is still strong despite volatility. Short-term volatility, gold has pulled back a little bit, but the long-term structural demand is intact. And of course, gold, they say here, is not going away. This is a story from the Wall Street Journal. But these demands on gold, these demands of what gold is doing, hasn't changed. And then the last story here, if you haven't heard of this guy, his name is Ray Dalio. So basically, he's saying you should have up to 15% of your money in gold. Why? This guy's a billionaire. He's an investor, been around a long time. He's been pushing this a lot, but he's getting a little more intense lately. But basically, he's pointing to the Iran conflict, how there's a lot of uncertainty around that. What could happen? Could that crash things? Could that break things? Could that hurt things? And you should be prepared for that. He's talking also about currency shifts, de-dollarization, in other words, people shifting away from the U.S. dollar as the central core basis of trade, and then rising global uncertainty. And what I would say to that is, we also had a story that came out very recently of OPEC, so the